last layer, dividend stocks. Okay, most of my spend in explaining bond because a lot more complex in bonds. But unfortunately, dividend stocks, okay, stock I can take one whole year to teach you, because stocks is like full of information and full of financial numbers you need to analyze. Okay, so what I can do in this, only I only have 2 hours to share with you about retirement planning. So of course I won't go into focus on how to pick a good dividend stock, what to analyze. That one will take whole day to teach you. Okay, so of course here I'm just showing you how you can screen out a good dividend stocks by using some screening tool. Okay, dividend stocks, right? Yeah. Okay, so this is probably the last layer that you can add on. Of course, you can add on other layer lah. I mean, you can put like property lah. I mean, your son will give you money. That one is for additional layer of income. Okay. I want to talk about traditional way to get passive income. Okay. And don't forget, when you choose which to invest, it's also based on how much effort you are willing to put in and how much potential return and potential risk that you want to take. Okay, like I mentioned, if you don't want to put in any effort, I mean, just go for CPF Life. Okay, if you want to put in some effort, then you have to discuss your advisor to pick a good endowment or annuity fund. Then that's it. Not much maintenance required. But if you want to pick a higher return or moderate return, come with moderate risk, then of course you must put in some effort to select good bond ETF or bond funds. All right. There's no right. I mean, that is the way, you see. So dividend stock is even higher effort, but also you may achieve higher potential return and also you exposed to higher risk. Okay, so that's why you must have all of some of these layers for your retirement, right? Yeah. So now I explained about fourth layer, which you will probably learn something by using some screening tool to select good dividend stocks. Okay. Don't just buy because of screening, right? You must do into a more in-depth analysis. Okay, but at least you have some base to start with, right? Like I mentioned, stock investment, high effort, high risk, of course, high return. Okay. And the conflicting is retirement, you need low effort, low risk, and probably moderate return. That's why stock investment should not be your core holding when you are in retirement. Okay, let me repeat. When you retire, don't hold too much stocks because that should not be the top holding. You can see the conflict here, right? Your conflict here is you need low risk, low effort for retirement. You don't want high risk, high effort for retirement. Okay, that is not retirement, right? Every day you worry about, stock price crash, all this. That is not a proper retirement, right? So don't hold too much in stock when you're approaching your retirement. Okay. Dividend stock, do take note that it's non-guaranteed. Okay, I want to emphasize non-guaranteed because a lot of people tell me, you buy REIT, confirm make money one. Now they never talk to me like that, right? Because last year they saw a crash, they start to know that, they start to realize that stock is not risk-free, stock is high risk. Okay, so do take note, stock is not guaranteed. Okay. Investment capital is not guaranteed, which you don't want a lot of holding in this because you don't want to risk your capital. Okay. Maximum drawdown, meaning maximum crash can be 50%, and that actually happened. Last year actually happened to some of the REITs and some of the stocks. So do take note that if you invest in stock, this will be the maximum drop that you should be expecting to have. Okay, if you cannot afford to absorb this fluctuation, then don't invest in dividend stock. Okay, and this is the actual scenario during the 2007-008 financial crisis, right? The decline for REITs actually dropped 70% in REITs. Singapore market, the blue chip dropped by 57%. So there is a real drop in global financial crisis. Okay, and of course the recent scenario during the last year COVID, the maximum drop over here, this is a Singapore REIT, is I think about probably even like 900 to 500 is about 400. That is probably about 50% drop as well, right? So that can happen to dividend stocks. Don't say dividend stock REITs are free. I mean, it's safe. It will never be safe, right? Yeah. So how to look for good dividend stocks? Okay. I have this dividend stock screener. Okay. To me, right? Because stock itself is high risk. Of course, I want to have more than 5% dividend yield. Okay. If anything less than that, might as well go for endowment, go for some bond, which is safer, right? Yeah. So that's why dividend stock to me must be more than 5%. Okay, why I put 10% here? Because of the screener. Okay, I don't want to screen out those 20-30%, and most likely will not be sustainable. That's why I don't want those kind of stocks in my screening, in my screener. Okay, I'll show the screener. And also, I don't want a smaller company. I want market cap, which is a size of company more than 500 million. Okay, you can even change to 1 billion. If you want a more comfortable holdings, you can change in the filter. Right, I'll show you later. Free cash flow per share must be more than dividend per share. Okay, so this is like what I use in the bond criteria. The yield to maturity for bond must be more than dividend yield. Okay, that is for bond. For stock, we want free cash flow per share more than dividend per share, so that likelihood of the dividend is sustainable. Okay, so these are my criteria, and try to have, if you want to have a dividend stocks, try to have 5 to 10 stocks for diversification. All right. Sector usually will give you is either REITs. Of course, REITs will still give dividend, financial, utilities. Okay, these are the sectors of stock that will give you likelihood that the dividend is higher. Okay, so now I want to show you the screener. Same thing, everything from poems. Okay, you go to fundamental view, and there is a stock screener over here. Okay, just maximize it, and then you can okay, of course my criteria more than 500 million. Okay, I don't want to have small cap. Sorry, I need to reset first. Yeah, I want to have more than 500 million. I want dividend yield more than 5%. Okay, I must put a cap. If not, it will give me funny stock that give you 100% dividend yield. So that's why I put 10% over here. Okay, and you can just screen. Okay, and you will get this list of stock that will pass your criteria. Right, of course, I want to have I want to sort it out based on higher dividend yield. So it's a rank it. Okay, and you can see that the first one is Lipo More. Okay, that's why you don't buy just because of dividend yield. You must right click and go to stock analytics. Right, then you see whether the free cash flow per share is it higher than the dividend per share. Okay, but Lipo More, I think you don't have to analyze. Okay, even though you have sufficient free cash flow per share, you should not buy because a lot of issue with this company. All right, but we can do some practice here. Okay, so you can see from stock analytics, right? There is a free cash flow to the firm over here, 33.38. Okay, this is in the form of $1 million. So what you need to do is you just use 33. Let me draw. See whether I can draw or not. Okay, I need to share. Okay, 33.38 million. Okay, divide by this number of share, common share outstanding, 3287. Okay, so what you need to do is to divide 3287. That will give you free cash flow per share. Okay, and the answer is let me calculate. 33.38 divided by 33.38 divided by 3287. That is 0.0101. Okay, so this will measure that the company is able to pay this if they want to. All right, then you look at the dividend per share that they pay to you is 0.0187. Okay, so in this case, they will pay you 0.0187. Okay, so you can see free cash flow per share is actually less than the dividend they pay to you. And you know that this is not going to sustain. I mean, the dividend they pay to you is not sustainable. Okay, so even though they give you the highest yield, you should not invest because of this reason. Okay, so that is how you can screen by using screener, and you can do a simple analysis to check whether they are able to pay you sustainable dividend. Very straightforward step, but honestly, you need to analyze more than this. Okay, that's why I only can share up to this stage, because more than that, I will need one whole day to teach.